The markets are currently closed, with the last trading session ending on Friday, December 5th. As of that closing bell, Opendoor Technologies, Inc., trading under the ticker symbol OPEN, sits at exactly $7.16 per share. The stock took a significant hit during the last active session, sliding down by roughly 5.4% or 41 cents from the previous open, capping off a week of intense volatility that saw it fluctuate between $7.12 and $7.58. If you were staring at your screen right now, hoping for a calm, steady climb, you are looking at the wrong ticker. This is not a savings account. This is a battleground. Most investors look at a company like Opendoor and expect a straightforward story about real estate recovery. The expectation is that as interest rates stabilize in late 2025, companies tied to the housing market should naturally float upward, buoyed by a returning tide of home buyers. That is the safe, comfortable narrative you might hear from a generalist financial advisor, but the reality is far more abrasive and complex. The reality is that Opendoor is not trading on housing fundamentals alone right now. It is trading on a friction point between survival and irrelevance. The stock is down significantly from its recent highs in September and October, where it briefly touched nearly $11, and this retreat to the $7 level is not just a dip, it is a stress test. The market is effectively asking whether this business model, algorithmic home flipping, can actually exist without the zero interest rate environment that birthed it. While the general consensus assumes the company is simply waiting for the Fed to cut rates further, the deeper truth is that Opendoor is undergoing a radical internal surgery, pivoting away from being a capital-heavy house flipper to a capital-light platform. This disconnect between a market waiting for a housing boom and a company frantically trying to change its DNA before cash runs out is where the opportunity and the danger lie. When you look at the recent price action, it is impossible to ignore the sheer aggression of the moves. A 5% drop on a Friday isn't just noise, it's a statement on liquidity and sentiment. You have to compare this behavior to the heavyweights. When you hold Apple stock, you expect a certain degree of insulation from daily panic. Even Tesla stock, known for its erratic behavior, often follows a clearer macroeconomic logic than what we are seeing here. Opendoor is moving with the desperate energy of a small-cap biotech firm awaiting FDA approval, rather than a multi-billion-dollar real estate tech company. This volatility is a double-edged sword that attracts a very specific type of market participant. On one side, you have the Robinhood and SoFi Invest crowds, retail traders who see a stock trading at $7 that used to trade at $30 and see nothing but upside optionality. They are looking at the chart, seeing the gap down, and thinking, this is a discount. On the other side, you have the institutional algos and short sellers who are looking at the balance sheet, seeing the cash burn, and betting that the equity eventually goes to zero. This tug of war creates the jagged intraday charts you see on your Fidelity trading platform or Interactive Brokers account. Let's talk about that volume. On Friday, over 46 million shares changed hands. That is not a sleepy Friday afternoon. That is a crowded exit and entry door. High volume on a down day usually signals institutional distribution, big players lightening their load. However, the stock held the $7.10 line, suggesting that there is a floor of buyers stepping in, perhaps anticipating a bounce or covering short positions. This is where the psychology of the trap comes in. Is $7 a floor, or is it a pause before the next leg down to $5? To answer that, you have to look beyond the chart and into the mechanics of the business itself. Opendoor's core problem has always been that it owns the asset. Unlike a Zillow or a Redfin, which primarily make money on ads or commissions, Opendoor buys the house. They take the risk. If the housing market sneezes, Opendoor catches pneumonia because they're holding millions of dollars in inventory that is suddenly worth less than what they paid. The Opendoor 2.0 strategy they've been touting in their recent earnings calls is an attempt to fix this. They want to partner with agents, use their software to facilitate sales without taking the house onto their own balance sheet, and effectively become a software company rather than a real estate hedge fund. This pivot is massive. It is comparable to if Nvidia stock suddenly decided to stop making chips and instead started selling the blueprints for chips to other manufacturers. It changes the entire margin profile of the company. If it works, Opendoor becomes a high-margin tech platform. If it fails, they're stuck with a lot of expensive houses and a lot of debt. This uncertainty is why you see such disparity in analyst targets. You have JP Morgan recently putting an $8 target on the stock, while others like Citi have had targets as low as 70 cents. When Wall Street can't agree on whether a company is worth less than $1 or double its current price, you know you're dealing with a highly speculative situation. This is not the kind of asset you tuck away in Schwab Intelligent portfolios and forget about for 10 years. This is an active management play. You have to watch the news flow, the mortgage rate data, and the weekly inventory reports with hawk-like attention. Speaking of attention, the broader retail sentiment around this name is fascinating. If you scroll through forums or talk to people using the Robinhood app, there is a persistent belief that Opendoor is the Amazon of real estate in waiting. The argument goes that the traditional process of buying a home is so painful, so archaic, and so filled with friction that eventually a digital-first solution must win. They are not wrong about the problem. Buying a house is terrible. It is slow, expensive, and opaque. But being right about the problem doesn't mean Opendoor has the right solution. The company burned billions proving that buying homes instantly is easy, but selling them profitably is incredibly hard. This is the reality check that has crushed the stock price over the last 2 years. The expectation was disruption. The reality was capital destruction. Now the company is trying to find a middle ground. Let's look at the financials that are driving this fear. In the recent Q3 report, revenue was down over 30% year over year. That is a scary number for a growth company. You generally want to see top-line growth, even if the bottom line is messy. But in this case, the revenue drop is partly intentional. They're buying fewer homes to reduce risk. They're trying to be disciplined. The question is, can they shrink their way to profitability? They're guiding for a break-even by 2026. In the stock market, 2026 is a lifetime away. A lot can happen in a year. Interest rates could spike again, a recession could hit. This requires patience, and the market is famously impatient. This is why you see the stock sell off on news that looks okay on the surface. Investors want proof now, not promises for next year. The macroeconomic backdrop for 2025 is the invisible hand guiding this stock. We are currently in a strange period where rates have come down from their peaks, but they haven't crashed. This leaves homeowners locked in to their low 3% mortgages from 2020 and 2021. They don't want to sell, because selling means trading a 3% rate to a 6% or 7% rate. This lack of inventory is actually a double-edged sword for Opendoor. On one hand, low inventory keeps home prices high, which protects the value of the homes Opendoor already owns. On the other hand, Opendoor needs volume. They need people to move. They need liquidity. If nobody is selling, Opendoor has no product to buy or flip. They're like a car dealership in a world where nobody wants to trade in their car. This lock-in effect is the single biggest headwind facing the company, and until it resolves, the stock will likely struggle to regain its all-time highs. However, there is a contrarian angle here. If the Fed becomes more aggressive with rate cuts in 2025, we could see a sudden thaw in the housing market. If that happens, Opendoor is positioned to capture a massive amount of that pent-up supply. Their platform is built for speed. If millions of homeowners suddenly decide, okay, it's time to move, they're not going to want to wait 60 days for a traditional closing. They might turn to Opendoor for the convenience. This is the call option scenario. You're buying the stock at $7, hoping that the macro environment shifts in their favor. It's a bet on the Fed as much as it is a bet on the company. Now, consider the tools available to you. If you are using a Fidelity trading platform or Interactive Brokers, you can see the depth of the market. You can see the bid-ask spread. On a stock like Open, that spread can widen quickly during panic selling. You need to be careful with market orders. Limit orders are your friend here. And for those using SoFi Active Investing or Robinhood Investments, be wary of margin. This stock has high beta, meaning it moves much more than the S&P 500.